What is up, you guys? Welcome back to the channel. In this video today, I'm going to be going over 10 safe dividend stocks that you should be buying, or at least thinking about, or maybe looking at to buy in 2020. So without further ado, let's just get into this video. First things first, if you are new here, what is going on? My name is Nikki, and would mean the absolute world to me if you would consider subscribing by hitting the MB in the bottom corner or the red subscribe button. Join the crew, join my journey. I post 2 times a week on this channel, ranging from finance, business, real estate, faith, my life. I believe that everybody's life is a journey, and every journey is worth sharing. I just document my steps along the way. So if you are into any of that, or if you just love hanging out with me half as much as I love hanging out with all y'all, please consider subscribing. Alright everybody, so before I get into the actual 10 stocks, I also want to talk about 3 things that I look for when I am looking at putting money into a dividend paying stock. I've talked about before on my channel, I invest in dividends and growth stocks, but my sweet spot are stocks that are growing, have potential to grow, have a history of growing, but also paying around a 2 to 4% dividend. Look, if the dividend yield percent gets too high, it makes me nervous. Okay, that's a personal preference. These companies that are paying a 12, 14, 16% dividend, like, that's not sustainable, and for me that just is gonna, that's just a red flag. Okay, I look for the sweet spot between the 2, the 4, maybe up to 5.5. I look really at 3 things. First thing is I look at how many years they've been paying this dividend out. Kind of common sense, the longer they've been paying it out, the more probably consistent and stable and reliable they are with their payments. The second thing that I look for is the dividend growth. So not only do I want companies paying for a long time and have that kind of resume, but I also want the payout growth of the percent of what they're paying to be increasing, you know, every year would be dope, but like 3 years, 5 years, 10 years, you want to make sure the growth is there for the dividend payment. And the third thing that I look for when investing in a dividend stock is the payout ratio of the company. Ideally, you would want that percent to be below 60%. It kind of makes sense if you just think about it. The companies are taking their profits and using that to pay out the shareholders that invest with them. If their payout ratio is over 60 and you're getting close to that 100 mark, or even I've seen some that are above, which is nutty, but that means that they are basically taking a huge piece of the earnings that their company has and paying it out. For instance, in times like this in 2020, when we got this thing called Corona working its way around the world, stocks payout ratios, if they're high, what's gonna happen is they're not gonna be able to pay it off because they don't have any income coming in, and they're using so much of what they do get and what they do have in cash reserves to pay out shareholders. So ideally, I mean, that really is gonna get cut, suspended. I mean, it's just kind of a recipe for disaster. So ideally, and I say ideally because there's a few things that, I mean, even there's, I think 1 or 2 stocks that I have that are up above 60. Just kind of no rule of thumb, 60 or below is kind of what at least I look for. You're probably okay 70 or below, maybe even 80 below, but I would just rather not risk it, okay? So the first one is one that I actually do not own yet. I have talked about it many freaking times, and I want to bad, like real bad, and I'm probably gonna pull the trigger in June. But that stock is Johnson & Johnson. So Johnson & Johnson is currently trading as of right now, and I am on a weekend, so this is probably different because markets will be open, or it's gonna be obviously after when I'm saying this, so take this with a grain of salt. But currently right now, at the time of filming this, Johnson & Johnson is trading at $144.37. Now also too, you guys, with this information that I got, I know on a previous video I talked about like which websites I really like to use. For this one I use Seeking Alpha and a website called Simply Safe Dividends. So the mix of the two are kind of where I got this information. If you want to pull it up, look at Seeking Alpha, look at Simply Safe Dividends, and just do your thing. Johnson & Johnson is currently paying a 2.8% dividend. This is like great. Their payout ratio is 52%, which means they're only using basically half of what they're making to pay out, which means for me, in my brain, that means they can sustain it. All right. Also, they've been paying their dividends for freaking 57 years. So I'll be damned. They're not cutting that bad boy, okay? They're not going to be slicing and dicing that up. And according to Simply Safe Dividend, they have a score of 99, which is like very safe, like pretty much the safest you could get. Look, I'm not getting too into depth about companies, what they do, and what I really love about them, but Johnson & Johnson Thompson because of how safe and secure and awesome that company is. I mentioned before, one of my best friends works for them, and I mean, what they give to their employees, it's just a very, very sound company. I'm gonna be dumping some cash into it next month. You're gonna have to stay tuned. Make sure you're subscribed because I always be posting out my additions, my payouts, kind of all that kind of stuff. So make sure you subscribe so you don't miss that. I honestly have not watched or read any comments from anybody who hates J&J. If you hate J&J, please let me know down below because I have yet to meet anyone. The next one that I'm going to get into is one that I actually do currently own. It's not really known for its dividend payment. That's another thing with this list, you guys. It's not like I'm trying to find the highest dividend yield. I'm really trying to find the most safe, stable, consistent, good enough payout for me, reliable kind of stocks, okay? It's very kind of low-key reserved. Next one is a tech giant, that is Microsoft. Now, you guys, I only have one share of Microsoft at like $167, so I'm a little upset I didn't buy a few at that price because currently right now it is trading at $183.51. Its dividend payout is only at 1.11%, which is very low, but I'm telling you, like, the room for this to go, I see them raising that. Like, it's gonna go. I don't know. Honestly, I know nothing, but I'm passionate about it. And another reason why I feel like they're gonna raise it is because their payout ratio is only 35.78%. They do have a pretty good history of paying their dividends, 16 years, okay? So that's solid. I mean, it's obviously not super long like some aristocrats or kings, but 16 years, I'm not worried about it. I personally think it's one of the best companies you could put your money into, like solo common stock companies that you could put your money into right now. So that is why it is on my list. And according to Simply Safe Dividends, it is also a 99%, just like J&J, so I feel safe. You should feel safe. You should make a move on Microsoft. Oh, also, side note, you guys, I want to buy more, obviously, of Microsoft, but do you guys think it's currently overpriced at the 184-ish mark right now? Please let me know down below so I get a little bit patient and I relax and I don't pull the trigger a little bit too soon. All right, guys, we are moving right along here. So these are not like in any order. It's not like number 1 is the best, number 10 is the worst. It's really just 10 that I feel are very solid. And the next 2 are actually ones that I do not own yet, but I definitely will. And being who I am, being a real estate agent, realtor here in Southern California, being very into home and home decor and home renovation, the first one of the 2 is Lowe's. So this is in the consumer discretionary sector. It is currently trading at a price of $122.25. It's also pretty low on its dividend at 1.8, but even better than Microsoft, its payout ratio is only 33%. And you may or may not know this, but it is closest to J&J with its payout history of 56 years. 56 damn years. 56 years. I mean, that makes me feel extremely they're not missing a payment. Like, that's the kind of tenant that you want in your rental property. That is what you need in your life. So there is some very good history there. And to just sprinkle a little bit of pepper on that is the fact that Simply Safe Dividend says it's 93% safe, which is dope. So that's all I have to say about Lowe's. I'm moving right on to the next one. The 4th one on my list. It is also consumer discretionary. It is also piggybacked off of Lowe's. You guessed it, it is Home Depot. Now, when I think Home Depot, I think more of like contractors use it. I kind of think of it like the Costco of home improvement. You buy things in bulk, it's for bigger projects, it's more professional grade. It is currently trading at $241.88, which I think is a little bit high. What do you think? You think Home Depot is overpriced? Please let me know. It has a much better dividend yield at 2.48%. Their payout ratio though is at 60%, so it's on the borderline of being a little bit high, but I still do not really worry about companies that have it in the 60 to honestly even like 65 range. They have been paying their dividend out for 11 years, so not, you know, substantial, but enough for me to be interested in that. And according to Simply Safe Dividends, it's only at an 87, which is still safe. It's still considered very safe, but I think because of that payout ratio, it's under 90, but you know what, I'm not worried. Okay, now this next one is, okay, I feel like you either love it or you hate it. I happen to fall more on the side of love it, but that one is AT&T. It's a communications sector stock company. And what I feel like is very consistent, safe. No, I do not believe there is a huge potential for growth, so this would kind of be a strictly dividend play for me. But because of 5G and maybe them getting into different kind of streamings, there might be some growth opportunity there. I think it's a little too early to tell, but I think there might be a little bit. They have a very solid dividend, so let's get into the stats of that. So they're currently trading at $29.88, which I think anything under 30 bucks is a go for AT&T. It doesn't fluctuate a ton, but I think under 30 you're getting a pretty good deal. But this is the part that is good. They pay a 6.96% dividend. That's pretty juicy, okay? That is very juicy. Yes, they are paying a payout ratio of 64%, which is a little bit high, but I don't mind it, okay? They have enough history of paying their dividend out for 35 years that I'm not worried about the 65% or 64% payout ratio. I'm really like, it's cool. But I think because of that, Simply Safe Dividend did give it a score of 65%. I don't know. What do you guys think? I hear a lot of people like, oh, love AT&T, love it so much. A lot of people are like, I would never invest in AT&T, it's a dead end. I don't know, I'm interested, I'm really honestly interested in what you guys think of AT&T. So please, please, please let me know down below, because maybe I'm making a big old mistake, I don't know. So my next stock on the list is also in the communications. It is Comcast. Now I currently own Comcast. Comcast is currently trading at $38.74. It's paying a 2.37, which for me, I like that, okay? Its payout ratio is lovely at 39%. They're barely using what they get to pay these shareholders. The only thing that's a little iffy is they've only been paying this out for 3 years, so it's a little too early to tell if long-term they're going to be really great and reliable. But because the payout ratio is so low, I think they're very safe. I think they're set to be very reliable, consistent. I don't see an issue with it really in the near future. And Simply Safe Dividend did give it a score of 89, and I think it is that high because of the payout ratio being so low. So this next one is a new-ish addition to my portfolio. I enjoy the products of another company more, but I like the numbers of this one better, and that is Pepsi. Now I don't know what it is. I mean, I own Coca-Cola too. Coca-Cola is not on my list, only because the numbers on Pepsi make more sense. Although Coca-Cola, I feel personally, is a very safe, strong, sound investment. I'm in Pepsi Blue, y'all. You know what? Come on. Give this video a thumbs up because I am in Pepsi Blue. I don't know why that deserves a thumbs up, but it does. It is currently trading at a price of $130.48. And you guys, listen to this. Pepsi pays a 3.13% dividend. I love when it's in the threes, okay? I feel very comfy, cozy, snuggy up in that 3 range. Now, here's the downside of Pepsi. It's got a downside. You know, we all have our flaws, and its flaw is the fact that its payout ratio is 77%. Now, do not worry about this too much because of 2 reasons. The first reason is they have been paying this out, okay? They've been paying their dividend out for 47 years. So in my mind, they're doing all right, okay? It is reliable. And then the second thing that makes me comfortable, even though the payout ratio is a little bit high, is the fact that they are so diversified in their product line. So they have like Frito-Lay chips. I believe they just recently acquired Rockstar Energy. Let me know if that's accurate. I don't want to give out false information, but I'm about 98.972% sure that they have acquired Rockstar Energy. So they're getting into the kind of, people really do love their energy drinks like Bang, Reign, Monster. I mean, I am not a fan. I do not consume energy drinks, but I know that there's a market for it. So for that, I really love the opportunity of growth that it provides Pepsi. I think with acquiring this, their product line, their brand diversity, I think the 77 pay ratio may go down, but like I said, they paid out for 47 years, so I'm really not concerned. Simply Safe Dividend gives them a 93. And the other thing is, in the last year, their dividend grew 6%. So they're increasing their dividend amount as well. So I don't know, Pepsi makes me feel some kind of way. I really do love it. Let's just move on to the next one. Okay, now I just want to put this out there that the next 2 that I'm going to talk about, I have never mentioned before on my channel, mostly because they're boring. Like, they just don't excite me. It's not sexy to say that you own these. But the next one that is on my list is Aflac. Now hold on a minute, hold on. I understand they're a financial sector. I understand financials are hot right now. Hot as in bad, I shouldn't say hot. Drowning. risky, okay? I know they're a little, you know, 50-50, okay? But I'm gonna just listen to me, just hear me out. Don't click off, don't. Because what I'm about to tell you are pretty good stats. So Aflac is currently trading for $34.70, so you don't need a lot of moolah to get a position into this and make moolah off your moolah. It pays a 3.23% dividend, which mama likes. Am I weird? Because I get more excited about like a 3.4, a 3.3 versus like a 5.7. Am I the only one? Something about a 3 point something, whatever, doesn't matter. All right, but listen to this, you guys. Okay, its payout ratio is 26%. Okay, so it's barely touching what it makes to pay everybody out, which means they are paying everybody out, which is what has led them to a 38-year dividend payout history. It's not hot, I get it. But if we're just talking numbers here, okay, it's a very, very good place. That is why Simply Safe Dividend had given them a 99%, which you cannot blame based off that, you know, resume. I don't own it. I'll probably throw it in there as a dividend move to make some money. I kind of like it. So the next one, you guys, moving right along here, is also the healthcare sector. It's a little bit sexier than Aflac because the word is cooler. That's really it. But it's called Medtronic. Here's the thing about Medtronic. I like the numbers, and then I also like the fact that last week on their earnings announcement, they announced that they will be raising their dividend percent. It is the 43rd consecutive payout raise for this company. So for me, that just shows that they're growing their dividends, their companies are growing, they have the capital and cash to be able to do that. So it's currently trading at a $94.72 stock price. Its payout ratio is 2.45, so it's not the highest, but it's definitely something worth, I think, looking at. Its payout ratio is 60%, which for me, I'm not worried. And they have a history of paying it for 19 years, which is not the best we've ever seen, but it's definitely on track. I mean, year after year, they're raising the payments, which means they can handle it. It's sustainable. I think they're reliable. I know I've never talked about them before ever, but I do like them for the dividend. And especially with that announcement of raising it, just makes me feel a little bit more comfortable. So let me know down below if you've ever thought about Medtronic before, because maybe I am alone in this. Simply Safe Dividend does give Medtronic a 99. So if you don't listen to me, listen to them, I guess. I mean. Alright guys, so we are moving into the last stock on my list for the 10 safe dividend stocks of 2020 and I guess beyond, honestly. IBM. So it's like information tech sector of the market. It's currently at $118.39. It's a little bit pricey to get you a share. Their dividend is at 5.51%, which besides AT&T is the highest one on my list. They only have a 59% payout ratio, which is awesome when their dividend yield is a 5.51, which means they are not using that much of their profits to pay you, which means you're most likely going to keep getting those payments. They have been paying that out for 21 years, which is a solid history. It's not the best, like I've said multiple times before, but it's not the worst. Simply Safe gives them a score of 65. To be honest, I think it's a little bit more safe than that, just because, and here's kind of where I'm at with IBM, the fact that cloud-based, looking at cloud-based opportunities for growth, I feel as though it has a very good chance of being a decently set growth stock as well. So mixed with the growth and the dividend safety of what it currently has, I think it's only gonna get better. And because that dividend is on the higher range of usually what I look at, because the payout ratio is only 59, I am very secure and confident in it. And IBM has been around for a very long time. So it's a company that I know has good track history with not only the dividends, but just being a freaking company in and of itself. And so for me, that is why it is on my list of 10 safe dividend stocks. You guys, I don't know, I felt like that whole thing was a journey in and of itself. If you agree or disagree with any of my selections, or if you have your own that I did not put on my list, which I'm sure you do, and you probably should, please let me know down below. As to, I love looking at what all the comments are and adding your recommendations to a list of mine to kind of look into to see if they would match me and my strategy and my, you know, portfolio. So you guys, if you made it this far to the end of the video, please smash that like button. It means honestly so much to me, and I know the YouTube algorithm absolutely loves it. It helps a tremendous amount to push my content out. So please, please, please smash it, make it blue, do what you gotta do with it. And if you are this far and you are not yet subscribed, please hit the subscribe button, join this crew, join the journey. Come on now, I know you want to, just hit the button. And like usual guys, if you're this far, you are the real MVPs. You know I love you. Come here. And as always, you guys, enjoy the journey, whatever your journey is. And always remember to do what sets your hearts on fire. And I will catch you all in my next video. Bye, guys.